Check. Good morning, traders. Welcome to the Traders Lab. I am your host, Tom B. Thanks for visiting today. We have a major move continuing from yesterday in the market, and we're going to get right into it. Thanks for visiting Trader Lab. This stream is about integrating Bookmap order flow tools with auction market theory using the volume profile in the intraday developing time frame. And thanks everybody for the screen and audio check. If you're visiting in YouTube, thank you for visiting Trader Lab. Appreciate your visit. And I'm going to do everything I can to make this extremely productive. If you're in the Trader Lab, please grab your context grid sheet. Trader Lab's a community of like-minded traders who come together to leverage their collective experience. This is about the business of trading. This is no nonsense. If you're interested in the business of trading, this is a community that is serious about it. It is not romper room, and this is not to make anyone uncomfortable. This is just the facts. Most of us have put a lot of time and effort over the years, or however long you've been trading, in order to create a viable business. And most of us have all walked, I should say, in your shoes, and we've all done the same things. The difference is, what can we do to change our outcome instead of repeating it over and over again? And the trap or catch-22 to developing traders is the random nature of the market and random winning trades. Random winning trades happen even if you have no trade plan. If you're just gambling and playing a video game, you're going to have winning trades. That ought to tell you something. Now, the business model that actually is proven is gaming. Gaming is anchored inputs in a random environment. Anchored inputs give you something you can measure. And if you can measure it, then you can tell whether or not you have a statistical edge. It's not complicated. What is complicated is our psychology and emotional states operating in an environment that's 100% random 100% of the time. Now, you don't have to accept it's random. Our nature is to create predictability and certainty. That is driven by psychology, not by the facts of the business model. So instead of trying to fit trading into your comfort and psychological needs of avoiding risk and the rest of it and creating certainty, we have to fit ourselves into a business model where there is 100% uncertainty. If you can solve for uncertainty and get a statistical edge that favors you over time, assuming you can then develop the discipline to push back the psychological impediments and emotional triggers that seek to avoid risk, and except if you can learn to accept risk with edge, that may give you the opportunity to create sustainability. That's the purpose of Trader Lab. You're all invited. Now let's move forward. We have tons to talk about in a very limited amount of time. And I'm going to remind everyone that there's a link in the bottom of YouTube. If you want to visit Trader Lab, there's a library of webinars, a document section, and of course, the Trader Lab community. And remember, this is about the business of trading and how to integrate Bookmap order flow tools into using a process based on market mechanics, how the market works, why it does what it does, and how at times you can get in alignment with it and operate with a statistical edge. That is the business. General disclosure, all Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Remember, please, this is not a trade calling room. We get into real time, we talk. Right? And don't forget, whoops, do not forget, I just lost the slide. Hold on. Life in the fast lane. Well, sorry, lost the slide here. Guys, I want to remind all of you that Bruce has a pilot program for extracting an edge. You can access this through the Bookmap server. Don't forget you can use the link in the bottom of YouTube if you want to visit Trader Lab and take advantage of all the education that's available at no cost. And you don't even have to be a Bookmap subscriber, just a hint. But you may find that if you can extract an edge and understand how the market works, Bookmap is a cutting-edge, high-tier order flow tool which can help you extend that edge and create more, obviously more edge, more opportunity. That's what it's all about. Now, this is how the market works. It's very simple. Auction market theory. What is the market? It's a shopping experience. Go to the supermarket, you're actually trading. What you're doing is you're accepting a fair price, which is what the sellers are looking for to create maximum volume. But at times they're going to put it on sale or the price gets too low. If the price gets too low, you throw four in the cart. And this is really a very simple concept. But the sellers are not going to keep it down there on sale indefinitely. Ultimately, they raise it back to a fair price, wherever that is. And the volume dries up when it's too low because you run out of sellers. If the price gets too high, the opposite thing happens. Less buyers are willing to pay a high price. Some will, most won't. If the sellers want to sell the product, they have to lower the price to attract the buyers. That's what creates our rotations in all time frames. So when you're thinking time frame, this process of rotation or auction is taking place everywhere. The way we see it is in the volume profile. And all the volume profile is, it's not hocus pocus, it's just price and volume. If we can measure the volume at a price, all prices are not created equal. The other element, and I'm running through this, but this is all available in Trader Lab, is context. What is the context? Well, let's look at the current context. What are we doing? See you later. Thanks for playing. You don't even get a coupon to the buffet. We're too busy. We're out of here. The context has changed. The market is liquidating. If we're in a liquidating market, do you really think you want to be a buyer when the higher time frame is selling and the current longs are being liquidated? Does that say buy or does it say sell? Does it say pick the bottom? Does it say trade counter rotations? In other words, when the shorts are getting squeezed, the weak shorts, or does it say use the counter rotations for alignment for continuation shorts? Very important, because the context or condition of the market, number one, it's not one-dimensional. It changes subject to time frame. But the other thing is, what's the dominant side? And I always think about it, advancing armies and counterattacks. Now, if an army is advancing against your position, and the captain says, I need some volunteers to counterattack and hold the line so we can retreat. Are you going to raise your hand and volunteer? Let me know, because that's what happens if you trade counter trend. You're volunteering to participate in pushing back an advancing side. Are you going to be able to hold that side? No, you're not. So instead of being in the counterattack, I want to align with the advancing side. Which side do you think has a statistical edge? Which side do you want to participate on? And then there's Bookmap order flow tools. I call it the tip of the spear. That's where we can kind of dial down inside of the participant behavior to potentially gain an edge. And here's examples of these. These are available in Trader Lab. There's no plug and play. Sorry to disappoint you. If you're looking for mechanical, the only one thing you need, if it was, we all would have done it if that was the case. So most of us, though, we're gravitating towards certainty. There is no certainty. There is process, there's edge, and there's random distribution of outcomes. Remember how casinos operate. They don't predict anything. They just trade, or you say, play games with edge. So these are some examples. You can download this. But these are not plug and play. There is nothing mechanical. But you can extrapolate and prepare yourself for what might happen and then see how it works. Now, let's go back to our grid sheet. Now, there's a couple little things in here. And this is nuanced. And this takes, what does it take? Knowledge, experience, practice, structure, discipline, and changing what you think this business is. You don't want to do it, it's okay. You don't need to do it. But you probably are having a certain result. And if that result is not moving in the direction you need in order to create sustainability, it might not be because of your effort. It's going to be that you don't understand the business and you're trying to fit this business into your psychology, which is comfort and risk avoidance, confirmation. Unfortunately, same as the casinos, we're going to have to pay the other side. If the casinos can pay the gamblers overhead and costs of production, is it possible we also have to pay the gamblers? So this is the RTH Open. I'm going to show you a couple ideas. This is yesterday's low. This is yesterday's value area. Value areas where 70% of the volume took place. And Let's go a little further. Now we know what happened yesterday. It was the Acapulco cliff dive. Traders in Trader Lab who sold in our first trades, if you follow yesterday's stream, we're near the high of the day. And for me, and I'm not saying this is the right thing, right? I'm only talking about me. I'm not saying it's the best idea. There was never a long. There was only shorts. And traders in Trader Lab who have a plan, and whether they took long or short is not material, had substantially profitable days. Now, not everybody, because why? Some traders don't do the work. Other traders are emotionally triggered. Other traders are developing. By the way, I've been doing this going on 47 years. I'm a developing trader, right? So it's okay. What's not okay is not doing the work to know where your trades have a statistical edge and when you're on the wrong side. That is not okay, but we have to learn it. So we have to build a business plan and then step by step, piece by piece, develop trades that I have shared. And all you got to do is make sure that you're aligned and know what the statistical probabilities are. Now let's get back to the market. This is called the naked volume point of control. Close your eyes if naked makes you uncomfortable. This is the highest retail or volume. Remember the shopping experience, fair price. And you're going, well, Tom, if it's fair, then what? Well, what happens if and this is yesterday's low, and this is yesterday's value area, and here's settlement. What happens if I open outside of range, outside of value? Now let's go to our grid sheet. We're opening outside, so it's a gap. What does it mean? The market is out of balance. That says we're rejecting maybe the previous valuation. And let's talk like shoppers. I'm not paying that. That's too high. And what happens? I leave the store. I'm outside of yesterday's range. Gap. What are the possibilities? Fill the gap, come back. But my grid sheet says the market's out of balance. It's the market responsive. What's responsive means? Gap low, fill the gap, come back in the range. But we're out of balance. That says, I'm not paying that. Now, again, no clue. Clueless. Maybe. So what are we looking at? What is the market's response? Are we gapping and going? What does it mean? If we gap and go, it's a possible trend day. What do? You trade in the direction of the imbalance, and the range potential is unlimited. This is in your hand at the open. Now, there's more. I'm going to take you into other nuance that I have shared in Trader Lab. Here it is. First of all, here's the open, and it's like, what's happening, right? That's what I go. But look, what's this? This is the ETH. Let me tell you what this is. This is kind of where we get into, let's just say, other things that most traders don't understand. I'm not saying there aren't others who do, but early on in my development, I learned market profile in the mid-1980s. I started trading in 1980, and this was like, what is this, right? Well, over time, I started seeing what I considered phenomena, and I couldn't figure it out. I was like, what does this mean? What does it mean anything? Here's what it means. This yellow line is called a developing point of control. Now, that's just language for high volume. Naked volume point of control is above us. High volume, shopping, retail. What happens if the buyers will not pay the current retail price? They get in the car, they drive to another store where the price is better. Now in the ETH, this is the new retail price, highest volume. And in the ETH, this shifts down. This says in a more shorter developing time frame, this is too high. It's right there, right there. Okay. So what do I know? This is maybe too high. This has a gap. What's above me is too high. And there's one more little piece. This is the current retail price, the overnight volume point of control. So I have the overnight volume point of control. I have the ETH low. And if you pull out your statistics sheet, and you have to vet everything for yourself, remember, I'm opening lower outside of range. There's a 91% probability I take out either the ETH high or low. If you're going to take a step out and take a big risk, which side do you think we might take out? The low or the high, considering we're rejecting everything? For me, I'm going to step out on a limb here. If I get under here, then what? My next target is 66.95, and this is a higher time frame target. If I get below there, we go down the financial food chain. Here, and this is the next target, 66.70. It happens to be the low of the day, but who knows? Not important. So my orientation is take a short and be willing to take a stop. Is that you? Oh, you're not willing to take a stop? Wrong business. You know why? What are stops? Overhead and cost of production. Is it a personal failure? Do you feel you're a victim? Or is it just part of the random distribution of outcomes? It's a question because it's important. How do you experience this? Is it a personal validation of your intelligence? Or maybe is it overhead and cost of production? Maybe it's the random distribution of outcomes. Do you need to get your self-worth validated? Wrong business. Do the casinos, what do they do when they pay the gamblers? Do they close the door? Do they think they're a failure? Do they think they're getting burned? And I'm referring to another conversation I was having this morning with someone. Are we victims or are we just playing statistics? I take stops. If I'm trading 47 years and I take stops, why shouldn't you take a stop? What is a stop? A stop is a trade that has an edge, that is validated. It shows up. You put it on. There's a random distribution of outcomes. If I take a stop, I'm protecting my account. I'm not here to be right. I'm here to be here for the next trade. Because over time, if I have an edge and I execute it, I'm not being burned. I'm taking intelligent risk with a random distribution of outcomes. And over time, if I have an edge, I'll get paid. And it might mean, just like the casinos, I have 3 losers in a row with the same trade. But if I've done the work, I know that trade is profitable over time. That's trading. So we have to decide, are we going to pay cost of production and overhead, or do we want a free ride? And there is no such thing in business. So, too high. Retail. 90% probability. Do you want to get long, Lewis? Me? Not so much. Gap, liquidating market, higher time frame participating. That's why yesterday was what it was. Let me show you the first trades. Now, this is not where you need to trade. This is where you need to narrate and understand what's happening. So this yellow line, don't forget, overnight volume point of control, variable high volume node, as I call it here, which is the last retail price in the ETH, and then it shifted, which says too high up here. Now I'm looking for shorts. Now, when I say looking, yeah, I'm looking. Where is it? Good luck with that. We don't know. So let's follow the language of the market. I don't use indicators. Doesn't mean you can't. I'm saying I don't. I found all they did was create more variables, more conflict. So I had to learn to read a language. So this is a foreign language. I mean, are we going to use Google Translate, or are we going to actually learn how the market works and speak the market? Do I get an advantage by understanding what this says versus letting some price-based derivative indicator, which is one-dimensional and doesn't know anything about context, drive the bus? Me, not so much. And here's why. I can't measure it. Because I used to think more inputs created more certainty. So our nature is to put more in to avoid risk. Well, if you can't avoid risks, no matter what you do you want more inputs, or do you want the minimal inputs so it is now consistent in a random environment? In other words, the games casinos play are the same. In other words, certain inputs. Blackjack, which I always refer to, 7 cards. They don't make them 10. They don't go 12. They don't put 30 cards in because it's going to help them because there's more inputs. Now you have an exponential number of possibilities. So if you have minimum inputs, you can measure that because you don't have the variables. You see, I mean, 3 times 3 is 9. 3 inputs only. You see what I mean? 3. So the idea is the more inputs, the more exponential possibilities. How do you measure that thing? You don't. I tried to do it with trading systems. So I kind of went that direction early on and built systems to try to extract metrics from many inputs. And all I did was curve fit. Same thing you're doing. So, except I did it much better. And I didn't get a better result. I just did it much better. This is too high. That's a variable high volume node. I made these terms up. Who knows? What does it say? Let's talk the language. Remember what happened in the ETH? Too high. It was here actually. Too high, too high, too high. Check. Open here. I'm sorry, open there. Selling right away. This is where the volume is. Too high. I'm out of here. Here, too high. This is a short. This is a short. This is a short. Your stop's got to be over the opening swing. Too much risk? You got to wait. What does it say? Let's talk language. I'm not paying that. I'm not paying that. Well, I'm not paying that. These are retail prices and microstructure. What do I see? Selling. Where's my buyers? I don't know. You see them? I know. Sweep. Liquidity. VPOC migration. Going to zero, Lewis. If I come across, then I can counter rotate. VWAP, mid, at a VHVN, and a possibility always to get thrown under the bus and get squeezed. Not willing to take a trade? No opportunity for profit. Afraid of getting stopped? Wrong business. Stops are not your enemy. I know you don't like them. Neither do I. But you know what I like? To be able to take the next trade. I'm not here to be right. I'm here to be profitable. Different, isn't it? So I understand that I'm going to take stops. I'm okay taking them, other than emotions. In other words, you feel one thing, but I'm sure the casinos don't get depressed, because they pay a gambler. The way that they get more gamblers in the door is to pay them. This is a short. This is VWAP, the VPOC in alignment with VHVN. Now we're in this thing a couple of minutes. If your jaw's on the floor and you think it's getting away from you, how do we trade a market that is a liquidating market when we have a gap, and instead of filling the gap, I get my sellers? Right here is a sweep. This is too high. So my resistance is here, here, and I got my mid. Now, look, it can do anything. So what do I look? If it gets away from me, I only have one way in, and that's called mean reversion. That is a counter rotation to come back to the mean retail price. Remember the shopping experience. This is what you always have to be thinking about. The shopping experience. Retail, I'm not paying that. It was too high over here, and it was too high over here. So if I come back here, this is called a variable high volume node. Now, I understand if you haven't seen this before, you're going, what? Shopping. You know how to shop? You already know how to trade. What you don't know is how to operate in random rotation. That, my friends, is the issue. And there's more, of course. Where do you take your trades? If you're in Trader Lab, you already know where you take your trades. What you don't know is whether you're going to take a stop or not. Welcome to trading. I don't know. The casinos could have figured it out. They would have. So would I. I can't. I take stops. And I take them. Why? I'm in a random environment. And if you can't take a stop and deal with paying, then you don't have a business. Because you're saying is, I want to be in a business, but I don't want to pay bills. How do you experience it? What is this? Variable high volume node. Where's my trade? It's either VWAP or mid because it's reversion, you see. So if you get short here, where's your stop go? Not there. Out here. Oh, you can't take that risk? Trade's not qualified. Break low. Where's my resistance now? Well, here. All I did was test. test, I'm under here. Now what? Well, remember we had this as a target coming down over 90% probability. Okay. And I'm out of range. What are we doing? We're out of here. Next target is here. So if I'm short, if I didn't get, and these are opening trades, this is more aggressive, takes more experience. So, if this thing's doing this and your jaw's on the floor, you're feeling FOMO. But if you're in Trader Lab, you already know this is the ETH low, just like checking a low of the day. And we come up, and it could have come there. If I get short here and it comes there, my stop has to be away from the mid because it could be a mid short too. Okay? Life. Doesn't fit your risk parameter? You don't take it. We break low. Now, is this too high? Yes, it is. So you have a short here. You have a short here. And your risk is out here. You see, as you're waiting, your risk goes up. Doesn't take away from the opportunity to come here. That's the next target, 95. I didn't show you the higher time frame, but these levels come from the higher time frame. There's a low down here from last time we were here. I put these on my chart. Okay, so there's stops here. What does the market tend to do? Where are the longs? Wow, they're in here. They're under here. Look what's sitting here. Liquidity. So if I know there's stops here and they become market orders, I can anticipate, not predict, anticipate a counter rotation here. Why? Great question. I get a sweep. Now order flow comes into this. I have buyers here. I got iceberg. And by the way, it's not predicted. It's maybe. Maybe it'll do this. Maybe it'll do that. Maybe I don't. This is now resistance. This when I break below it. Now, subject to, and this was a target, stops, I can get a counter rotation, short covering. Now, do I get long here? Me? No, not so much. When I come above here, I break here, I'm above. This is resistance becomes support, and it's either a trade management. This is now where your time frame and trade plan come in, or sets up a counter rotation for a continuation shorts. Now this is trade plan. Right? Where are we trying to go? So we have VWAP. We have an outside edge here. So let's say, look at this one here. I get a sweep. I'm at an outside edge, and I'm looking for mean reversion. Where's the mean? It's right there. If I take a short here, I have to scale here. And then looking for it to fall out the bottom. This is a structured short at a location. Now, if you don't get scaled, you're going to take a stop. Don't go behind the garage and step on a rate. It's just overhead and cost of production. Where's my next location? Here's the VWAP. And there's another outside edge. So these are called distributions. This is like your store down the street. Retail price is here. Outside edge. I'm not paying that. That's what happened here. But if I push through, then I have the VWAP and I have another outside edge. This is part of the thrill of not knowing. It's called randomness. Watch. Now, if you take the VWAP, you would take a stop. Or, let me give you the or you have to be further away. Let's assume. I like to assume I take stops. I do, by the way. And I don't like them. Do you? I haven't gotten to the point where I go, but I also know that I'm going to take stops. I've accepted that there's no perfection in a random environment. I know it's like horseshoes and hand grenades. I know areas, and that's all you can do is get an area, and then I'm going to use order flow triggers. This is a trigger right here. Break low, trigger, entry is here. Now, if you have the discipline the way the trigger works is location. Now, there's two pieces of this, and you have to always think, and there's no prediction, but I want to give you a sense of this. I know I'm going to get retail behavior at the VWAP. I'm not thrilled joining what I consider average mechanical retail traders, but I get a trigger here. I know I can do the Acapulco cliff dive from here if these guys are right. If I take a short, which is right here, I need to be thinking about the high volume and getting risk neutral. If I don't get risk neutral, I will take a stop here. If I get risk neutral, and that means whatever the risk is from entry to scale. So if I run a 2-lot, I'm only talking 2 lots for the purpose of developing traders. You can run 3s, 4s, whatever you want to do once you've vetted it. But I'm only talking about minimums because when we're developing traders, we need to develop the discipline, the metrics that allow us to add contracts and runners. But until we can trade 2, we can't trade any. If you can't trade 1 trade, you will trade no trades. So if you come to Trader Lab, it's like coming, it's building. It's foundational in business. We're going to build a business together. And whether or not you succeed is not up to me. It's going to be up to you and your ability to do the work and overcome your emotional obstacles. The biggest obstacle to learning the trade, other than doing the work, is the ability to manage yourself, your fear, your emotions, the primal wiring. This is a short. Either you get risk neutral or you take a stop. Okay. And it's grumble, nasty, all those things we say that you can't say. And then mid. So now what did I do? I anticipate and I don't like taking a trade here, but I have to follow my plan. I don't know if it's going to go down. Do you? Here's what I know. I'm vulnerable here because this is what mechanical retail traders do. Am I willing to take a stop? I have to be. I don't like it. I come up here. I get my sweep. This is an order flow phenomena. I had it here, you see, and I got that. Then I get this, and I get this. So, all right, this says potential up. It's up. Uh-oh. Now, same scenario, mid. And now I took these guys out. This is what's important. I know there's buy stops here, including me. 89, 5, 161, 1. Now, and the sweep. Watch. Sellers are here. This is a trigger. I can get short here. My stop cannot go here. It's got to be above because I can pop the mid from these guys and then go lower. That's what I know. I don't know anything else. Do you? Scaled. See how it pops the mid? So here, if I took it here, I'd get scaled and I get taken out. Or, let me give you the or, subject to your plan, I be above here. The trade fails here. I'm just saying, subject to, you put your stop here, you can anticipate being taken out. And if you're okay with that, that's fine. For me, any of these shorts here, this is where it fails, above here, because this is my retail price. Now, so I can tell you what I do. I'm not saying it's a good idea. But so if you're getting stopped, as long as you're under here, you're okay. Now, this shifts down. This is an important event. This now becomes too high. If this is too high, I can be taking rotations for mean reversion to come here. Too high. Now, there. Now, this is resistance. Okay? So the idea of this is to go here to here. Now, I want to show you a long. Now, let me explain what it means by a long. This is a short cover right here. Let me show it to you. I got into the stops under here. I come under this liquidity. This is my retail price. This is too high. It's going lower, lower, lower. As far as I know, we're going to zero. I get a sweep here. I came into the liquidity here. and I'm looking for it to hold this, comes across. So now this is a cover, or subject to time frame, your stop has to be out here and you get taken out. Me, I tend to get out, but that's, again, you have to know before it happens what you're going to do under this condition. Is it a long, or is it a get out of Dodge? Look for the counter rotation and then put the trade back out again. In a liquidating market, it's only shorts for me. So what's up here? Liquidity here. Sweep. This is VPOC. This is support. Variable high volume node. So this is, let's talk the language again. If I leave this, it might be too low. Where was it too high? Last place is up here, right there, right there. I come above it, I've got my full session VWAP, no clue. When I break under here, I can sell this, and my stop's got to be above this thing, out here. Watch. Where am I trying to go? Right here for a scale. So this is your scale. So now let's go a little further. Suppose you're going here and your teeth are chattering and you're going, I don't know. Of course we don't know. When I break here, I can sell this. I got to be out here. If I break here, I can sell this. I got to be out here. I'm selling variable high volume node, sweeps, sell. Not your trade, nothing to worry about. Here. Scale. I'm under here. Now, chop, if you're micromanaging in this volatility, you're going to have a problem. Okay, that's part of trading. I break below here. This was support. There was my sweep. There's my counter trend. This is carried forward because I had behavior here. If I can get short in here, out here, here, break low, short, same thing here. Break low, short, stop here. Break low, short, stop here. Break low, entry, stop there. It's all the same. These are all multiple locations. Scale there, because it was too low, shopping experience. Too high, too low, the trend's down. And then this is support, because that's where the reaction was. If I can get below here, this potentially can become resistance. Resistance. What is this? Order flow trigger, another short, or nothing, right? Now, 9:30 Central Time, we have something called the IB. We have two trades at the IB. Let me come back. 9:30. Okay. And we had the Michigan pre, right? 9 a.m. So you would get short covering ahead of the report, right? You would know that. You'd be out or whatever. One moment. This is your support because our buyers were over here. I can take the scale here or here in a downtrend. If now at 9:30 Central Time, we have the IB continuation trade. And what it is there's over 90% probability, closer to 98% probability, past performance, not indicative future results. We take out the first hour's low or high. And for me, I'm going for the low. I'm going to, step out here, take a lot of risk and say, we're liquidating. I don't think we're taking out the high of the day at this point. So, and fill the gap, which we could. So once I'm under here, this is my support and it becomes resistance. This is the IB. We take it out here. This sets up something called the IB continuation trade, but this is my resistance. So if I break here, I know this is resistance, and I don't know what it's going to do. So I can put the trade out here, or here. So if I take it here, that's where my resistance is. I got to be outside. If I take it here, I got to be out here. If I take it here or here, I got to be out here. If I put this trade on and there's a sweep, I don't know, but I do know what was support. And I do know now, if I get below support, you guys know this, resistance. I can sell it here. 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 All these are structured trades. Where am I trying to go? There, 70. So I don't know about you. That's 10 points. That's initially where I'm trying to go. And where do I come back? Here. Sweep, IB, resistance is here. I can put the trade back out again. And all I got to do is get risk neutral. If I get below this, it opens up the door for lower. If I don't get below it, I'm going to take a stop. What am I going to do? I don't know. VPOC migration, south, and then trade management and whatever. Where are we? Oh, there we are. Okay, so did I take stops? Yes. Am I profitable? Yes. Am I okay with that? I'll live with it. Would you? And that doesn't mean anything about the overall outcome of the day. So what am I doing? I'm aligned with the condition of the market. I'm only trading from the dominant side. If I recognize a long in my trade plan and in my trade management that is vetted, that it gives me an opportunity to cover, or I am higher time frame oriented and I'm going to ride through these rotations. That's not my business, it's yours. I'm going to take the structured trades I've vetted, and I have to think like a retail trader, but not act like one. I have to keep my stops in this volatility away from the noise. My nature, like yours, is to be risk adverse. That means my nature is to put my stops with other retail traders because they are risk adverse. I have learned over many years that that's not a recipe for success. It's a recipe for failure, because what most retail traders do is dictated by their primal wiring and risk aversion, not by the business. We have to separate how we feel from what we've learned. And when we keep taking stops, we have to look back and say, why did I take a stop there? Well, sometimes, you put the trade on, and you're probing for a location. I never look at it like I'm looking to know. I'm looking to sample the market at locations where I anticipate behavior. Remember the word I said, anticipate, not predict. If I think I can predict anything, I'm in the wrong business again. Remember, the casinos can't predict anything. If they could predict the winning hands and the losing hands, for them, I think they'd skip the losing ones, wouldn't they? Well, how can you if they haven't figured out how to do it? Does that make sense? Well, Greenhorn Bull, don't worry about what I have. It's what you have. You know, this is trading. This is the business. What's going to happen? I don't know. All I can do is it's like waiting for a bus. Where's my trade? If I don't have a trade, I'm sitting here waiting for it. I'm waiting for my trade. I'm looking to align with what I perceive currently to be the condition of the market. If the market is currently short, I can anticipate counter rotations somewhere. If it comes back across here, then I already anticipate my next potential trades are out here, not here. Why? Stops are here, stops are here, stops are here. So am I going to step in front of this? No. What happens if I only come here and then it goes lower? It's not my trade. So I just don't have a trade. In a liquidating market, the only trades I have are reversion trades. This is the primary condition of the market, which is continuation shorts in the remember I said at the top of the stream, Context. That's the number one driver. What is the context? Down until it changes. And by the way, how will I know it has changed? After I take a stop and I see change that I have defined. Then I go, oh, look at that. The context is changing. I don't have a qualified trade now. I just sit back in my Barca lounger and I'm waiting for my plan and my trades, right? That's it. There's nothing more to this business than that. It's not a video game. Oh, should I sell this? There's a sweep. Well, no, not me. You, and this might be the only, as far as it gets, and then it continues down because I don't have a trade here. So I have nothing to do. What I'm looking for that qualifies for me, and this is not a recommendation, is a squeeze. And I have to always look back. Where are the retail traders trailing their stops? It's above these highs. So what might happen? If I run out of sellers down here, which I have, and there's a sweep, I can then anticipate coming across these buyers, which are buy stops, maybe. If I can get into their stops, those buyers, and look, by the way, I got to move this thing out. Here, remember this was support, right? Let's look, where is it? Here. Outside edge. Now, I don't know where it's going to go. It might only come here and bounce off and go down. It's not my trade. I'd be done until I get another trade, which might show up here or not. I'm not in the, what's it going to do? I tell you, it's every moment. What is it going to do? It's random. What I am in the business of, where do I have an edge? I have it here. And this would be what's called mean reversion. And the goal is to get risk neutral and come back here. Why? I'm not paying that. It's too high. All right, this is retail. That's what mean reversion is. The primary trade, in my opinion, and this is, if you want to understand market mechanics, the market is a pricing mechanism. What does it tend to do? If a price is too high, we leave it. I'm not paying that. We break below. Now this support becomes resistance. Subject to your trade plan, this could be a short. More advanced. Break here. IB continuation trade, structured trade. Where's my resistance? It's here. This can be a short. I break low. I come back to the IB. This is a short. I break low. I come back to the IB. I'm leaning against this. This is a short. 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 This either up here or we don't get above it. But it's not a short for me. This is a short. And we don't ever have to get above this. Notice what we did here. We went above. We broke below. Too high. What about this? Is it still too high? Or are we going to squeeze? I won't take a short here, and this could be the short of the century. Goes down another 100 points. I'm just saying it could. Why? Why wouldn't it? Can you tell me it won't? Or can you tell me that it can? I'm going to say it can, and I'm going to say maybe. Because the best I have is maybe. So I'm not trading or predicting. I'm aligning. But what I also have learned is market mechanics. And I understand I want to take advantage of other traders' behavior. And their stops are here. So do I want to step in front of their stops? No. I want to use their stops to squeeze out. Remember how the market works. This market's going down. Okay. What's trailing the market? Buyers. Buy stops. What happens to these guys? This is what happens to them. Is it going to happen? No clue. You see, not my job to predict. My job's to align. If I understand how the market works, I'm going to be looking out in this area, not at a rigid price. What else do I know? There's stops at the VWAP in the mid, and this is resistance. And it has slop. Slop is created by momentum. You see the buy stops going off? No, I don't know where it's going to go. Might only come back to the IB. What else do I know about the IB? There's buy stops here. So me, not going to sell it now. What am I going to do? I want these guys to come out. Stops. And then I want to see, do I get exhaustion and a sell trigger? And where's my resistance? It's out here. And this is not a trade recommendation. So I already know where my trade is. And by the way, you remember all the way up at the top, I already knew if I squeezed that I was out of balance and I might fill the gap. If I filled the gap and checked up here and I came out the IB high, we came out the IB low, but if I came out the IB high, I would short it. And that's called the IBF, which is a reversion trade. Down here, I'm not taking the IBF, and it might be the low of the century. I'm going to take only the IBC because that's aligned. So down here, and not now because it's already done its thing and there's shorts. But initially, it was IBC from the bottom, alignment with the trend. And if it came out the top early, I would take the short, the IBF, because it's aligned for reversion with the trend. We always get this conversation. This is not mechanical. Wouldn't it be nice? Just, plug it in and have your computer do it. Doesn't work that way. Wouldn't it be nice? So what I know is, what do I know? Stops are here. Am I going to take a short here? No, because stops are here. And so this is the area. Now it can come anywhere out here. This is part of the thrill. So I have it what's called a low volume node here. Let me turn on some levels so we can see them. And I know what is a low volume node. Let's go back to our store. I'm not paying that outside edge. What else do I know? Well, maybe there's stops out at that outside edge because it's not auctioned. So what I know is as I come up towards these levels, and now I'm squeezing, right? My resistance is here and out in here. So I hang out. I sit here and I go, that's interesting. Where's my trigger? Let's look. Not a trade recommendation. I take stops. So never enjoyed those, but I've kind of changed my how I experience them. Hard to do because of my emotional attachment. It's a trigger, right? So now it's monitor it. What happens up here? I got my stops above this and my outside edge is up here. So kind of like looking, And the idea of this thing is to take the stops out. This is the trigger. This is where the entry is, and you have to get risk neutral. That's life in the fast lane. So, and if the trade works, it's come in there. That's mean reversion. If not, you're going to get squeezed some more and come outside. Mean reversion, and the joke, of course, is it's mean, is where's the outside edge? That's the hard part, you see. So what I try to do when I take these is I have to get risk neutral. And by the way, if I don't get risk, so I either get a scratch, my broker sends me a gift basket, or I take a stop. And I'm okay with it because I'm probing, because the further outside it goes, instead of me being emotionally attached and disappointed and angry, the further outside it goes, assuming the context is still down and I know it can come out here, I can still take this trade because I'm trading towards this. The problem, of course, is, where's outside, you say. So, I can take a few stops in this, and if it goes past my area, then I'm just going to, basically stand down. I'm going to go, okay, something's changing and I'm out of alignment. Okay. Cost of production and overhead, not predictable. So we're out here. This is our outside edge, okay? So if you took this one, you'd be risk neutral, you'd scratch. You take another one up here, you have to be protected. Your outside edge is this LVN. So this is really where these trades would fail, would be out here. So if you're micromanaging, what I do when I put these trades on, I don't know the exact location. I have to look back to where my resistance is and my outside edge is, which is here, and try to get risk neutral. I have no clue, but I am trying to go So does the risk reward work for me in spite of taking stops? Yeah, it does. So that's kind of what I do. And then whatever it does, it does. So if I'm taking the trades I'm supposed to take, even though I'm going to take stops, I'm still very profitable. That's kind of how I experience it. And I know this is important. IB is important. Squeezing out the shorts that have their stops wherever they were, out here someplace, out here, and then trying to get short out here for coming back there. That's called mean reversion. Mean underlined, but that's a trade. In this volatility, you cannot use a scalpel. You can't. Because look how far we came here. If you took this short, I mean, how far did we go above this? A couple points. See? Or you're using a micrometer on this, and how many stops would you take? So if I take a stop, I'm telling you, I'm all right. I'm going here. And unless it breaks structure. My outside is this. This is called a low volume node. And this is the retail price. Remember the shopping. I'm not paying that. All right. Let's check the retail price. Now, this is important, what happens right here. BPOC migration, more volume here. Here's the possibilities. If I break high, I'm going to be guarded and I might liquidate the short. This is my support. This is the next place I got to clear to continue down. If I don't continue lower, hasta la vista, thanks for playing. Trade's over. This is trading. I'm not saying it's the best way to trade. I don't even know if it's I don't know anything. Oh, and what else? The IB. So in the profile, what we're looking at here is this high volume, too high. I'm not paying that. Oh, and where was our resistance? You do remember, where was it? I don't remember where it was. It's up here somewhere. Losing it. Here. So I have to watch this very carefully here. So I'm trying to go here for the next location. And if I break high here, then I might be out of the trade. And this is subject to your plan, not mine. But I'm reading the language of the market. What does it say? Let's come back. No indicators. What does it say? Retail. What happens if it's too high? I'm going to come back to where it was too low. So this is support. If I can't get here, then I'm going to squeeze again. Then the trade might be over and I get back in the Barca Lounger. Or if this is too high, I'm going to check what was too low. And then if I clear this, I continue. If I don't clear this, or I can't stay under here, then the trade's over. I get back in the Barca Lounger. I'm okay with this. This is just one trade out of thousands. Just the way it is. Does that make sense? How are we doing in YouTube? You guys conscious, or did you hit your head on the keyboard? Hope you're getting something out of this. This is Trader Lab. Sorry, it ain't. It ain't pretty. It's trading. You know, we're always going to be triggered, fearful. I am. And the idea of the fear is the uncertainty. I'm wired to avoid risk. You are too. I mean, the only reason the species is still here is because we said, oh, is there an apex predator behind the rock? I'm out of here. So we want to be sure. Hey, how about this? We can't be sure. If you can't be sure, then you've got to build a business around uncertainty. That's our problem. We come in, I know I did. I'm only talking about me, and I don't think I'm any different than you. I didn't even know what the heck I was getting into. There were no off-floor traders when I started in 1980. We didn't have candles. We didn't even have computers or an internet. Nada. So it was bar charts. I mean, that's where I go. I still have my ruler from back then when I draw a trend line. Does that make sense? So I came into the business, I'm risk adverse. I'm not a risk seeker. I'm risk adverse. So for me is I don't want to lose a dime. Oh no. So I built everything on the idea that I wanted to. I came in with the belief that my job, remember the word, belief, that my job was to squeeze the risk out and create certainty. And I came into the business with that because I'm already let's say pre-wired to behave that way. So those beliefs are not based on the business, they're based on primal wiring. So the decisions we are making are driven by things we don't understand. There's more depth, what's behind our behavior. One of the things we've never had to figure out when we come to this business is what are the primal drivers, because it works out in the real world. Avoid risk. Don't jump off the cliff without a parachute, or just don't jump off the cliff. Gee, there's risk there. We avoid it. Well, here we got to jump off the cliff. So our nature's not to do it, or try to solve so we don't do it, right? Put a fence up. Well, we don't have a fence here. So this trade would be over. I'm okay with that. Now, here's the other piece. I know resistance is here. I know I can come back here and come here. But what does the language tell me? Maybe this is too low. And this is the retail price. If I can't get here, then I can come out here and return here. So this is still mean reversion. The problem for us is, do I keep my stop out here and give back open trade equity? Because this is where my sellers took control, you see? Do I use this counter rotation to put another trade on to come back here, which is still mean reversion? And if I can get under here, then I got this. I couldn't tell you what to do for you. I won't tell you what I would do, because you shouldn't do what I do. You need to find a place of peace, comfort with the discomfort. A thing of, I get risk neutral here, and then if it doesn't break here, the chances are it's going to come back. If I don't get above here, I can come back here. If I get above here, I'm going to squeeze. Let me show you why. And this is Trader Lab. Guys, I can't cover everything because I'm trading. You guys think of time frames, I don't use the clock. I use the volume. It's just a different way to look at the market. Because for me, I trade, remember, the auction. And what is this auction? Too high, too low, retail. Watch. If I put a box around this consolidation, and consolidations are auctions, they really are. Let's look at it. Too high, I'm not paying that. On sale. Buyers are here, sellers are here. Chop, 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 chop. Liquidity is there. Retail price is there, right? In the microstructure, buyers are here. If I break below the buyers, now I have resistance. I have resistance there, and I have the high volume, which is resistance here. What I am doing in a multiple time frame is trading reversion to there, reversion to there. I always say, learn mean reversion. It potentially is the key to the kingdom. And what is this? Reversion. So if I'm getting short here or here, I'm going there. If I come above here, I can be out. I can put it back on there. Or my stop is out here because I know my sellers are there, and this is the high volume, which acts the same as this. And if I get below this, I got support here. I can scale here or not. And if I get below that, I continue on my merry way. Is this logical? Because what I'm really sharing with you is what the auction. And again, it's not predictive. Are you guys with me? Green Hornet. So too high, scale. Too high, scale. Too high, scale. Maybe. Resistance. Got to clear this. Clear this. Hasta la vista. I'll send you a postcard. See? So this is structured trading. Now, I'm showing you market mechanics. The determination of whether you take this trade is whether it qualifies and there's enough range to get risk neutral. So when I'm putting a trade on, I can recognize the mechanics, but if I'm too close to the obstacle, then the trade doesn't qualify. All right? It doesn't matter if it goes to zero. What matters is risk management. There's always another trade. Joe Mack, if you're using Investor RT and you want to duplicate my charts, there's a section in the forum for Trader Lab that is specifically and exclusively for the Trader Lab participants who use IRT. And you can download my chart definitions and duplicate what you see. In Bookmap, that is it's different because IRT is my higher time frame. And I'm going to show you a little something. Now, this is the higher time frame. By higher, I mean intermediate. So now you remember day before yesterday, this is where the buy stops were here, sell stops were under here. The market opened, went lower first, got more shorts, came across the range and took the shorts out in this leg. And the key to this setting up yesterday was what happened here. We squeezed, and instead of going up and forming acceptance, by the end of the day, we came all the way down, and this rejected it. So this was a short squeeze. That set up yesterday. Then yesterday, we opened, could not get back to the retail price, and the overnight volume point of control, the last auction was right here. Came up, and that set up shorts, and we rejected the value area, which sets up one direction only south of the border, and then it was down to here and out the bottom, and at the time 41, I think the locations were 41. Today, gap under the overnight volume point of control, the ETH high, the ETH low was nearby, the next target was 95, which we took out, and this is a bigger target down here, which wherever it is, over here, 70, which was important on the way up. The next target, and then it's c'est la guerre. Let's see how our current short is doing. Not a recommendation, who knows? Oh, see, too high, too high. See the structure, too high, break, too high. It's too high. How would you know that? If you understand how the market works, you can learn. Not saying you'll ever be a profitable trader. And what do I know about this? It was too low. So if I get here and I take a short, I got this, I got this. Then put your helmet on. And it may just come back here. So we're trading reversion. That's what this is. The trend is down. I only trade from the primary driver, the short. I don't get cued. I don't go, oh, I'm going to buy this. I'm not interested in buying it. Somebody else can buy it. They deserve a profit if they get it. I don't have the same edge or any edge to go long in a liquidating market. So what I do, I'm only giving you an idea, is I trade what's too high, where's my resistance, where's my stop, where's my retail price, target, resistance, target, resistance, target, target, then what? And the then what's, I don't know, trade management. This is the Trader Lab. Again, guys, I don't know what, when it comes to trading, I haven't found a better way personally to trade. And I will tell you, I know a significant number of traders who trade large size. Some of them are former floor traders, and this is a primary piece because this is the truth of the market. It's not an indicator. It's not an indicator. What it is showing you price and volume. Remember how shopping works. If you're going to the store to buy your can of tuna and it's $2 a can, but you need it for the casserole, you'll pay it. But there's no line outside the store if the price is too high. If the sellers want to sell, get buyers, I should say, they got to lower their price to get a buyer. If we get a buyer and we counter rotate, but the sellers are looking to sell it, if they can get a better price for it, they're going to sell it where the buyers got run over. So the buyers were here. This is the absorption. You see the delta. But where's the sellers? Up here, sellers, buyers. Break low, trigger. This is a Trader Lab trigger. Come on up here, sweep into a location. That's a short. Boom. Test it. Sorry, Charlie. You heard of Charlie the tuna? break. Oh, let's come back. Here, have some more. Icebergs, icebergs, icebergs. They're selling the counter rotations. Now, traders who don't understand trading are going to be buying these things, thinking, oh, it can't go lower at the bottom. Really? I'm going to tell you is I won't know where the low of anything is. Why would I try to pick the low when I don't know? Until hindsight. Well, I'm going to pay to find out where the low of the day is by taking a stop. In the meantime, short, 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 short. Yeah, and I'll take a stop. Which side do you want to trade from? Are you busy picking the bottom because it can't go any lower? By the way, we've all done that, so don't worry about it. But are you going to keep doing it? What else do I know? Let's look at structure. I know this is too high. I know this is my outside edge. I know I can build trades that I'm just trading there to there to there, or there to there to there to out here. And what is it? I'm not paying that. Retail. Yeah, but it's on sale. Rotation. You can build trades and just go bang, bang, bang in trade management. You see? But in a downtrend, are you taking longs? Now, I understand. We've all done it. But why would you keep doing it? Is it reasonable to think in a liquidating market we might take this out at some point? And I'm saying might because that might be the low of the day. But here's the question for you. Is it the low of the day? Here, volunteer an answer. Is this the low of the day? What do you think? Now, it's a fair question, isn't it? Is it the low of the day? I'll tell you what I think. Maybe. So that's right. The trend is your friend. Until the trend changes, which it hasn't, I'm only short. Now, one of you will pick the low of the day. In the meantime, you'll go out of business, most likely, picking the low of the day. Everybody gets lucky. But is there an edge? See, this is a business of statistical probability, not predictability, right? So if we accept the business model, we're not in the business of picking the low. It'll be very clear. By the way, Joe, if you're looking for the TPO profile chart, it's just click the thing, select the colors. It's very simple. So come to Trader Lab. I'll be glad to show it to you in Trader Lab. But it's a very simple thing. There's nothing special about it. TPOs are fixed. They're 30-minute brackets. Before we had volume, we only had time. So it was a 30-minute bracket. They called them TPOs. The TPO chart, I really don't do much with them. I look at them because I grew up on them. I actually learned market profile from the guy who created. That's Peter Stottlemyre. And back then, I think it was mid-'80s when I learned it. It was licensed by CBOT. So let's look at this thing. It's another way to look at it. So the gray area is the volume. The TPOs are these letters. I don't know if I can make it bigger. So this is what a 30-minute bracket looks like. So we used to only have this. These are low volume areas. This is a distribution. I'm not paying that. Too low. Retail. If the shoppers go, this is a store because it's a distribution. I think of them as stores. I'm out of here. See you later. Okay. But for the day so far, where's the highest volume? It's right here. This is our retail price. But where am I? I'm out here now. What might that mean? I'm not paying that. What might it say? You got to be kidding. I'm out of here. New retail price, high volume, microstructure. I'm in multiple time frames. Where am I trying to go? Out here. I got to get below here. If I can't get under here, I can come back up here. Oh, it's too low. Let's come back to where it's too high. And this is my outside edge. And it's the same thing you're seeing right here. There, I should say. Low volume. Actually, let's match them up. 77. Yeah, this. So this is like an outside edge. If I push through here, I come out here. Low volume area. I'm not paying that, but it could be this is right here, is it? I don't know. I'm below this high volume. Get out of here. fair price. I'm under the IB. Get out of here. Too high, low volume. See how it rotates? This is what distributions of volume look like. So when the volume dries up, why? Because there's less buyers. Well, if I don't have buyers, how am I going to go higher? And if I come down here and it's too low, then we may just do this. So I can build my trade plan just around this. Is there enough range for you? 65 to 85, 20 points. Can you work with that? I can. And I'm all right if I put the thing on and, look where it came. 70. What's at 70? It's out here and this. So I don't know. So it's trade management. I don't know what it's going to do. I've given up putting my brain through this predictive thing. If the casinos can't predict what's going to happen, what makes you think you can or I can? If you accept you're in a random environment where you don't know, you're off the hook because you can't know. Now, what you need to be doing is aligning and having a plan for trade management. I always say in Trader Lab, this is not a business of predicting. It's a business of alignment and plan. I don't make it up here. I'm not going, what should I do? Because I don't know what the market's going to do. What I should do is know what I will do based on what happens, not what I think will happen, because I only have what might happen. And what might happen? What might happen is the low volume. Why? Because that's where I found my buyers and I counter-rotated. If I build a trade, which was from where? I don't remember. Was it out here? Can't remember. Let me get this off the screen because I can't remember anything. I can't remember the last trade. I just take them as they come. Where was our last short? Now, these aren't trade recommendations. Is this a trade that would work for you? You need to understand why. Not if it will, or that it will with certainty, why it might. And the might is where we take our trades and our risk in order to get this out here, because that's where my buyers were, which was created by the stops here, you see. So this sets up the counter rotation. This is why it could have been a trade management opportunity. And I come up here to where I know my resistance is, and I have my shorts. Now I have what? Where my buyers were. But what is my trend? Down. So right here is my support. I can be out of the trade right here. Get back in the Barca Lounger. Now, what does your plan tell you to do? So, subject to the number of contracts, it's get risk neutral, short, get risk neutral. Stop goes up here, and you're in the Barca Lounger with your teeth chattering, and now you're deploying a trade management process, and you accept you're not going to get all of it. Because now you're, quote, betting that we're going to take out the low of the day. And if we only come down here and rotate, your trailing stop takes you out, and basically you punch the clock, and you get a paycheck or a stop. You see, this is the Trader Lab. I wish I can make it more appealing to you. I just follow the yellow brick road. And what's the yellow brick road? It's mean reversion. Mean reversion. Coming down to high volume is mean reversion. What do you need primarily to trade? Mean reversion and an understanding of how the market works. Remember, we all start in this business with indicators. And you open your trading toolbox. Have you ever asked yourself why there's 200 indicators in that thing? Here's why. Because they all work randomly and they don't work with an edge unless you can figure out how to get one with random inputs. I tried that with systems to overcome the problem. It didn't. It just did it differently, same problem. So I was trying to compress the market to fit into what happened previously. But the market is unique at every moment. The behavior of the participants is unique. What I know is what might happen. And I also know where it might happen also. Low volume outside edge. See, I don't know what's going to happen. So Where's my support? You do remember, wasn't it now? So, now, I can't tell you what'll happen. I can tell you that if I see buying, I can just bail out of this trade and I'd be completely okay with it. Why? Let's go back to the discussion. I'm not paying that. Yeah, but it's on sale. See? Rotation. So subject to my time frame, I can be scaling again or flat and not be concerned with it taking out the low and continuing the Acapulco cliff dive. And the reason for this is what happened here. Buyer. So if I know my buyers were here and I had a sweep and now support is right there, right there. See, here, let me draw a little box around this thing. Same process as what's above. I'm just showing you from the other side. You can define where behavior might happen. You cannot predict it. There's a low volume node, okay? Right there, LVN. So what I know about it is I had my sellers here and my buyers are here. When I break above the stops, which are here, now I know my buyers took over here. If I come back here, I can scale here, close the trade, and it's just based. If I'm running a 2-lot, guys, and I always talk about 2 lots as a minimum configuration, my objective is to help traders build a business and a trade plan and then expand it. But if you can't take one trade and extract a statistical probability, in other words, learn the trade, understand it, and wait for it. It's like waiting for your bus. Your bus shows up because you've done the work to know this is an area, and now you have a trigger, and you put your stop where it's supposed to go. You take your stop, step up, pay your bills, or the trade gets you risk neutral. Now you're managing the lunatic under the hood. Your fear, hide, I call it. Your primal wiring, the chemicals that are released in your brain. You understand this is a chemical thing, that when you have fear, there's a primal wiring that's pushing back against the fear. It's why we've survived. So it's not stopping. I tried for years to stop those emotions. I really thought that if I could get rid of those, I'd trade better. But unfortunately, it took me a few years to figure out I couldn't stop it. So then I had to accommodate it by understanding it and then putting it aside, saying yeah, you're trying to protect me and you don't know the difference. I'm talking to myself now, between getting run over by a bus or this, because my mind perceives the risk. It's releasing cortisol. And if you don't know what all this stuff is, these are hormones that are released. There's chemicals in your in your primal wiring that are wired to keep you out of danger. Well, this is perceived as danger. It can't differentiate. So you're going to now have this fear, and the fear is to protect you. So it's thanks for protecting me, but no thank you right now. So I feel it, I acknowledge it, and I know I cannot respond to it. My job is to understand market mechanics and respond based on my plan. What I was starting to say here is everything I do here is based on a plan, not on how I feel about it. I know right here is the outside edge, and I mentioned it to you. Now, I also have to say to you, I'm not trying to say I'm right. I'm saying is I understand what might happen and where, and I'm as wrong as everybody else. But because I have an edge, I'm wrong less than I'm right. And wrong or right is not a right or wrong, really. It's a edge output. So when I'm wrong or right, I'm right all the time if I'm following my plan. The outcome is random, but that doesn't make me wrong. It means that that specific interaction with the other participants, which is random, paid those guys. Overhead and costs of production. I had to change how I experienced it. Now, I still have emotional response, how you feel, disappointed. If you get picked off by one pick or something, anger, why not? But so what? I can feel it, but I have to ignore it. I do understand how the market works. I don't understand what would happen here, but I can tell you that if I understand why this happened and where the buyers were, is it unreasonable for me not to be watching this area? Right there. See? Is everybody tracking? Is this making some sense? Can you see how Trader Lab might help you or not. I don't know. It might be a solution or it might not fit your psychology, and you may never find TraderLab a solution, because learning to trade is also undoing the things you believe to be true that might not be true in this environment. The things that work in the outside world, it's like being on Pluto. Um, Here, you're in a different place. The rules that work and protect you outside of trading are going to be the obstacle in the environment you're in. It's like you landed on, Pluto or Mars, and it's a different environment, different oxygen, different gravity, all that. So you have to live or operate differently here, and that's up to you. But these are structured trades. You can learn these. And how many of these do you need? If you develop one trade, and by one doesn't mean one time, the condition repeats over and over again. This is a structured trade from there to there. And it could have kept going. See, my job's not to predict. My job is to align. My job is to understand how the market works. My job is to be prepared to cover this trade when it comes back to where the buyers took over here. You would know that if you're in TraderLab. Now, what you do about it, that's your trade plan and your business. What I do about it doesn't have to be what you do about it. I'm just giving you some ideas in the sense of what you can accomplish. But you have to roll your sleeves up, and you have to be willing to develop, become a professional. If you want to compete in this environment, you're going to have to become really good at this. But you only need to learn one trade to become profitable, in my opinion. Because with one trade, you're going to have to work, you're going to have to deal with your fear. And the fear is the biggest obstacle, because we all experience it. And that's what creates FOMO, fear of loss, chasing the trades, making them up. You lose your mind. And you're losing your mind because you're wired to chase. Think about it. You guys have a dog, and the squirrel runs and the dog lunges. That's its primal wiring. We do the same thing. Try to catch the food, bring back to the cave, so you don't starve for the winter. That's the FOMO triggering. So we all experience these primal triggers. And on the other side of that, when you're supposed to get short, you're not certain. So now you're wired to avoid the risk. So you're wired to avoid the risk. And then when you are certain, you get short here and your risk is here. If it's 100% uncertain 100% of the time, am I better off with my uncertainty with less risk than you are with your certainty with more risk in an environment where it's always uncertain? Just a little thought for you. Hope you're getting something out of this, guys. Please give a like, support the channel. Click on the link in the bottom of YouTube. If you're interested in TraderLab, it's a community of like-minded traders who come together to leverage their collective experience. TraderLab looks something like this. It's not about me. This is about everyone. It takes leverage in order to have an opportunity to build this business out. We have to support each other. This will be the most challenging thing you ever do, maybe, in your life, because it is completely counterintuitive. So it's going to take some things. Start with our library of webinars. This one has 34,000 views. It really is about the business. It's a primer webinar. There's a lot more here. Stop gambling, start winning, trading multiple time frames, understanding how to get in alignment. Are you trapped in Trader Groundhog Day? That's me. Work hard, wake up in the same place. Random winning trades, but no edge. Leaking equity. Trading gaps and trend days. Like today, you might want to look at that. Trading VPOC migration. This is more advanced, but it'll give you some sense of how the market works, why it does what it does, and how you can get in alignment with it. Don't forget to leave the like. Thanks for visiting TraderLab. Review this over the weekend. Pass that link over to your buddies if you think this might be useful for them. Appreciate you visiting TraderLab and all your support. Remember, there's no cost for this, no cost for all the additional education. Bookmap is investing in your success, and it's for the idea that if you win, they win. Wouldn't you like to be in an environment that is not just about software, but about investing in your success? Use the link in the bottom of YouTube if you're inclined. There's no cost. You won't be solicited or abused. Please leave the like on the way out. Look forward to seeing you next week. And thanks again for visiting the Trader Lab. Really appreciate it.